Look at this chart. You identify a perfect technical setup on gold, wait for the breakout, and take your position. Then, almost immediately, the price violently snaps downward and hits your stop loss. Retail traders often chalk these pinpoint reversals up to bad luck or intentional market manipulation. These failures stem from the map itself. Lagging two-dimensional indicators like moving averages and trend lines rely on past prices, leaving them blind to the present market reality. By relying strictly on historical price patterns, directional traders are constantly wiped out by massive, invisible liquidity voids they cannot quantify. Multi-billion-dollar derivatives flow and the mechanical obligations of institutional market makers now dictate the direction of the gold market. The options market has grown so large that the underlying futures price acts as a secondary byproduct of massive institutional positioning. Mapping the live institutional options matrix is the only way to see the structural forces actually moving price right now. When you buy an option, an institutional dealer is usually taking the opposite side. To remain market neutral, these dealers must immediately hedge their exposure. To offset the risk of sold options, dealers physically buy or sell the underlying gold futures, a process called delta hedging. But this risk is dynamic. As gold's spot price moves, dealers must constantly expand or shrink hedges to maintain equilibrium. The rate of this change is called gamma. It is the mechanical recalibration that forces dealers to execute trades on the open market, specifically because price is moving. When you aggregate the gamma exposure of tens of thousands of contracts, including hypersensitive 0DTE options, you map the exact price levels where institutions are active. The sheer volume of these hedging requirements constrains and channels price action, creating a mechanical blueprint for how the market must move. In the gold market, these localized clusters of gamma exposure stack up at specific strike prices, forming structural boundaries on the chart. This topographic grid highlights the call and put walls. When gold's price rallies into a call wall, dealers sell futures to stay neutral. This physically blocks the breakout and forces price down, creating reversals retail traders mistake for manipulation. Between these walls lies the gamma flip. This is the exact price pivot where aggregate dealer exposure transitions from net long gamma to net short gamma. These boundaries define a mechanical landscape where algorithmic floors and ceilings often supersede the influence of sentiment or news. Mapping options data directly onto a gold futures chart resolves the informational gap. You are now looking at the market in 3 dimensions. This chart shows a positive gamma regime, occurring when gold trades above the gamma flip line. In this regime, market makers are structurally forced to buy weakness and sell strength. Breakouts usually fail, so the strategy is to fade extremes and expect range-bound chop. Dropping below the gamma flip triggers a violent shift into a negative gamma regime. Here, dealers are forced to sell into weakness, creating rapid trend acceleration and directional expansion. A breach of the gamma line requires an immediate change in the playbook, pivoting from range-bound scalping to aggressive trend following. When a structural wall finally breaks, dealers must panic hedge their risk. This creates a violent trend that instantly wipes out anyone fighting the move. Options data reveals exactly where institutional liquidity must act right now, rather than reflecting where price was yesterday. Trading in alignment with these mechanical constraints allows you to stop providing liquidity for algorithmic traps. Capturing alpha in modern derivatives requires seeing the mathematical structures operating invisibly in the present.